Okay, everyone, we're going to go ahead and get started. Welcome to the Ichimoku Strategies webinar. I'm Michelle Burgett. I'm the Marketing Director for FX at One Glance. We certainly appreciate you all taking time out of your busy schedules to join us for this webinar. Just to give you a little bit of information, we just kind of got FX at One Glance into full swing. We have some great people on board that you'll get to eventually meet. Some of you are meeting me for the first time, so I certainly appreciate being here. In today's forum, you're going to actually learn two of the main strategies that Chaos Trader uses. And as you know, the Ichimoku strategy is a system that only recently hit the American market. And actually, by learning this system, you'll be empowered and you'll have a clear competitive advantage against the majority of traders that are out there. So after we're done, I'd like for you to stick around so you can hear about our 4-week Ichimoku course. In this course, you'll be learning not only the strategies that Chaos Trader is going to present to you today, but you'll be learning a lot more. He's going to give you some tips that are really valuable. So stick around so that you can hear about that. Now, we have a couple of minor house rules. One of them is, if you can, please get all of your typing done prior to the start of this seminar, which we've already begun. So I'm asking if you get a chance to please not type into the actual chat box right now, because what happens is there's a beeping noise that comes out as you type in chat, and then that of course is a little distracting to Chaos Trader when he's presenting. So save all your questions because we certainly are going to get those from you, and every time he gives you a strategy or presents something to you, he will give you an opportunity to ask questions after. So we will get to your questions, and we thank you so much for your patience with that. Let's also get started by looking at our disclaimer. That's right here on the screen, so I'll give you a few seconds to read over the risk disclaimer. Okay, so as you're reading that, we just want to let you know that Chaos Trader 63 is far beyond other teachers with his knowledge and his dissection of the Ichimoku system. As you know, this is a complicated system, but Chaos Trader knows what he's doing with this. His longevity is a sign of success in that he has studied this and studied it, and now he's able to present it to you, hopefully in a clear and concise way so that you can understand it and then put it to good use. So without further ado, welcome Chaos Trader 63.
All right, thank you, Michelle. I guess I'm about ready to get going. Guys, as he mentioned earlier, please don't type into the chat box because it makes a noise and it disrupts the presentation because it takes me off course of what I'm trying to think or do. So this is being recorded. You'll be able to go back and check it out. I've done about 5 or 6 of these so far, and every recording has messed up. So I definitely made sure that this one comes out right because I thought the last webinar was really good, but I don't know. The last one was really good, but is everybody hearing us? Okay, yeah. Somebody says they're not hearing us. So if you're not hearing, maybe you want to sign out and come back in. But as of now, please stop typing because into the chat box because I'm going to start the presentation, and that noise will be on the recording also. All right. So what is Ichimoku? Ichimoku. Okay, see that is interrupting me when you type into the chat box. All right, so what is Ichimoku? Ichimoku is scribbled on a chart. To some people, it may look that way, but actually, it's order on your chart. And you're probably asking, how is it order on the chart? It looks so messy. Okay, well, Ichimoku translates to one glance equilibrium chart. So with that, you have market equilibrium. The market likes to get back into equilibrium. So there's going to be a level of supply and demand, basically overbought, oversold. Well, in between those levels is equilibrium. If you're in equilibrium, you're not oversold or you're not overbought. You're not excess supply, you're not excess demand. So you're right in the middle. And that's what the market likes to do. It likes to get back to equilibrium. So knowing where equilibrium is and being able to trade from that area is very strong. All right, so a market that is in disequilibrium, price is too high. Eventually the prices will fall. Let me get this for you guys. Eventually prices will fall. And then the market has to come back down into equilibrium. And then market that's in disequilibrium also, prices are too low. Eventually prices will rise and come back into equilibrium and then escape equilibrium and go back out of equilibrium. So you'll be back in the disequilibrium. So the market goes back and forth between that. So how does the Ichimoku work? All the parts work together in harmony, just like a Swiss clock. So basically Ichimoku was developed and started by a Japanese journalist named Goichi Hosada. And as you can see, he sat down and had a few beers, and then he came up with the Ichimoku Kinko Hayu. So we know it's reliable, being that he was drinking and came up with the system. All right, so he developed this system in the late 1930s and released it to the public in 1968. So basically, he took like 30 years to study this thing. He back tested it and studied it for almost 30 years. So with 30 years of testing this, you have to give it some validity. You have to give the guy some validity for what he's done, his work. So that's why I try not to change too much of the system, because he's tested it for 30 years. I've messed with it since 2000. So one of us is better than the other, and I think he knows more than I do. So I'm going with what he's presenting to me. All right, so to trade the two strategies that I'm going to show you tonight, you need to know the components of the Ichimoku system, okay? And basically, we're going to go over these really quick. And one of the components that we're really going to use is the Kijun-sen. So we'll be using that Kijun-sen a lot. That's going to be the one that's going to do everything for us. So let's go over these other ones real quick. The Tenkan-sen is also known as the conversion line, and I really don't know these myself. I know them as Tenkan-sen. I don't study the other version. I know it as the Tenkan-sen. Okay, but people that don't really study Ichimoku, they call it the conversion line. This is calculated with the highest high and the lowest low for the past 9 periods divided by 2. Then you have the Kijun-sen. This is a very important one that we're going to be using. It's also known as the reference line, and it's calculated the same as the Tenkan-sen but on a higher level because it's for the past 26 periods. It takes the highest high and the lowest low, divides that in 2. That's where you get that equilibrium from. When you divide that into 2, you're at the midpoint of the past 26 periods. That's where the market's equilibrium is for the past 26 periods, that midpoint, and that's where Kijun-sen will always be. That's why it's a very important support and resistance level, and it's a level that we trade off of, and it's a level that we use for trend lines and everything to that extent. The Chico span is also known as the lagging line because it's behind current price 26 periods. So basically what I'm saying is, if you look at your chart right now and you're on a daily chart, where price is today, go back 26 bars, and that's where the Kijun-sen will be, but at the same level as far as height wise or level on your chart. That's where you're going to find your Tenkan-sen, your Chico span. Now we have the Senko span A, also known as leading or preceding line 1. The calculation here is the Tenkan-sen and the Kijun-sen divided by 2, plotted 26 time periods ahead. Senko span B, also known as the leading or preceding line. This calculates the highest high and lowest low divided by 2, calculated over the past 52 periods and shifted 26 periods ahead. The Senko span B is always going to be the one of the clouds that you look at and see it's flat, and that's where a lot of support and resistance comes to, back to the Senko span B. Then you have your Kumo, also known as the cloud. That's the shaded area between sync out span A and B. So sync out span A and B, I don't even really say, oh, I'm worried about sync out span A and B. I take that as a whole with the cloud, okay? That's how you can shorten that up and just worry about the cloud, not that. So here we want to study the Kijun-sen because this is going to be a vital part of our trading for the two strategies we're going to use. So the calculation, the highest high and the lowest low of the past 26 periods divided by 2. So basically that's going to be your midpoint for the past 26 periods. It's your midterm bias of the market. So it's going to tell you on a midterm range if the market is bullish or bearish. If the bears are, if you have candles below the Kijun-sen, then that means for the past 26 periods, your average is basically a bearish average. Okay, so if you understand that the Kijun-sen is the midterm level, that's the equilibrium of the market. So wherever you see your candles above or below, you know what the market bias is for the medium term. This is also going to show us medium term support and resistance, medium term momentum. It's a built-in trend line because usually when price crosses the Kijun-sen, you have a possible change of your trend direction. And now don't take this as always, but it's just like a trend line. A trend line is not always guaranteed either. So basically, when you see price cross that line, be aware that something could happen, that you could have a change of your direction. All right, so it's also used as a trailing stop, and we'll see that when we look at some of these charts. It adjusts with the market volatility. So when I get into a trade, I put my stop loss at the Kijun-sen, and as the Kijun-sen moves, so does my stop loss. It's a magnet to price because of that equilibrium. So price wants to pull back to equilibrium. It wants to get back to the average of what it's been. So it'll pull back to that equilibrium of the Kijun-sen. It's mainly used a lot for the Tenkan-sen, with the Tenkan-sen to create the TK crossover. And I use it alone to create the Kijun-sen bounce signal. All right. So what we want to learn is if the market's in excess supply, your market's in disequilibrium. Here's your Kijun-sen level. Here's the excess supply level. Market's far from the Kijun-sen. That's disequilibrium. You're too far away from the Kijun-sen. The Kijun-sen is the average for the 26 periods. You want to be at that average for the 26 periods. All right. So here's excess supply, excess demand, and here's equilibrium. In between excess supply and demand, you have equilibrium, where you also find your Chico span. And look where price is hanging around, right around that Chico span. Sorry, I'm saying Chico span. Price is hanging right around that Kijun-sen, all along right here. That blue line is your Kijun-sen, and it stays with that all the way over here. And here it came back and pulled back to that level. And this is where we look for trading opportunities when it gets near that level again, because that's basically a pullback and then the market goes. And here we had the breakthrough of the level. This is like the trend line level. Once it crosses that level, we know it's a bearish market now, so we can look for short opportunities. All right, so the Kijun-sen up here is equilibrium. The market is far from equilibrium with excess demand down here. So here the market is too far away from the Kijun-sen. We're at disequilibrium. The market wants to pull back towards the Kijun-sen, and there it does. Pulls back towards the Kijun-sen. Then it crosses over the Kijun-sen. There we may have a change of trend direction. We start looking to see what the market's going to do, if it's going to go the other way. Now here you see the Kijun-sen acting as a trend line. Here it is, this blue line, and it's following right up here with price. Then here it flattens out. As it flattens out, price breaks through and price goes down the other way. Now this could be just a pullback, we don't know, but you see it's a change of the direction of the trend. And here it does the same thing, and you can look at any chart and you'll see that when the market's trending, you'll see it doing this. And then the market broke that level. Here's your Kijun-sen. The market broke the trend line. This is our trend line, and as it did that, it continued to go higher. Okay, so that would have been a good trade for us because we know where market equilibrium is, and we saw the change of trend direction before everybody else. So I want to teach you a strategy One of them is Kumo breakout trades. I'm sure you've seen this a million times on my YouTube videos, and I'm hounding on this because basically this is one of the most successful strategies that I use, and it's one that brings the most amount of pips to me. It's one that I use more than any other one, so I want to get into that one. All right, so we're looking at the bullish rules here. So if you're bullish, looking for a bullish trade, price needs to break and close above the Kumo cloud, and it must be the first candle out of there. Okay, we don't want to trade if it's not the first candle out, then it's called something else. It's not a Kumo breakout. We need the very first candle to break through there. All right, price needs to close above the Kijun-sen, so you're not going to take a trade unless it's above the Kijun-sen on the breakout. And you need a bright future, and I'll show you your future. That's your bullish Kumo twist right here. I'll show that to you on the chart when we get to it. And then your Chico span, what I keep on saying is because the Chico span is very important, but a lot of people don't use it on their charts. And you'll see I don't even have it on my chart because I know where that level is automatically from studying this so long. But you need to have Chico span above the price of 26 periods ago if you're going long. All right, so you need to have these four things in line, and then your stop loss is either at the breakout candle, at the Kumo top or bottom, at the Kijun-sen, or the fractal level. And these are all stop loss areas that you can use, and I'll show you those levels when we get to the charts, and you can decide which ones you want to use. I stick with the Kijun-sen, and sometime I'll move to the fractal level. Those are the two main ones that I use. The fractal level is very important, and I'm going to get on the fractal thing a little bit, but fractals tell you the structure of your market, which way that market is going, so they're very important. And then your exit's going to be below the Kijun-sen. When price crosses and closes below the Kijun-sen, you're out. Or else if it closes below the fractal level, that means your structure has changed. And for the bear rules, it's going to be just the opposite. So you could look at that. All right, so here's a bullish Kumo breakout trade. Price comes down, breaks out of the cloud. First candle out of the cloud, we're in the trade. It breaks out, moves all the way down. I never have to get out of this trade or do anything, because it doesn't tell me not to do anything. I just ride this market all the way down to this level, 285 pips. And then the market moves up and comes up to the Kijun-sen. Here's where you definitely would have got out because this candle closed above the Kijun-sen. And then here the market continues down. So this whole move was 675 pips. And doing this strategy with using the Kumo breakout and closing on the other side of the Kijun-sen, that'll help you to catch a lot of that market. And I'll show you how. Here's another trade, a bullish Kumo breakout trade. Here, first candle out of the cloud. I mean, there's no reason for me not to take this. And let's go over some of the rules while we're showing this, so you guys can see what I'm looking at when I take this. Okay, so here's the first candle out of the cloud. That's a breakout. I have my bullish future. This is the bullish future right here when you get that twist. The way I can tell is because my cloud changes over from this color here to the bluish color. And once I see that, then I know 26 periods ahead, which would be maybe this area, 26 periods ahead, that I am having a bright future or a bullish future or a Kumo twist that is bullish. Okay, so I have that. I have price above the cloud, the breakout. I have 26 periods back. My Chico span will be back here, 26 candles back. It's going to be above price, so this is more than 26 candles, so I know that I'm bullish on that term. So now all I need to do is get into the market. Boom, the candle closes, I'm in the market. I could put my stop loss a whole bunch of places. One of them is this fractal level. It's the first level right here. The second level is this level right here, the Kijun-sen. And the third level is this level here, the cloud, because the Ichimoku system has 4 support and resistance levels, and that's going to be your Tenkan-sen first, your Kijun-sen, the top of the cloud, and then the bottom of the cloud. We're not going to get into all that right now because that's not part of this webinar. Okay, so let's move on. So here's another breakout. First candle out, you take the trade. You look over here, 26 periods ahead. 26 periods ahead, you had a bearish future. So it was just crossing over right here. Once you got that crossover, you're good to take the trade. And then price of 26 periods ago was below this price realm right here. So we were below the price. I take the breakout. I never have to get out of the market, but here is where a novice trader gets out of the market, because it goes down here and then starts to pull all the way back. I don't get out because I'm waiting for this level to get crossed over. And what happens? The market continues downwards. And you could have made a lot of money on that trade there. There was no reason to get out of the market at all. Here's where you would have got out of the market right there. And this looks easy on the chart, on the aftermath, but I'll show you it's easy even after, before the aftermath. Here's another breakout, a bearish Kumo breakout trade. First candle out, 26 periods into the future. I got a TK cross, I got a Kumo twist right here, and that's going to be my dark future. So that's a bearish future. Okay, so I have that, and then 26 periods back, 26 periods back, this is more than 26 periods. My Chiku span will be here. It's below price. That's what I need. All right, and then I got the breakout. There's no reason for me to get out of this trade. I get out right here. That's the level I get out. Totally, this was 1,045 pips. There's other ways to get back into this market around this Kijun-sen level, and those are other strategies that I use that I'm not going to get into today. And I would be able to catch some more of this level right here. All right, so here we go. Another breakout. First candle out. We got our future that is bright right here. So we got a bright future. And 26 periods back, we're above price. Now, sometime this Kumo top can hold you up, because that's going to be a support and resistance level. So you're below that, but you know that that's going to be a level you want to be careful of. Okay. So what happens here? I'm in the trade. Then the trade dies out here. The novice trader gets out. And I say, see you later. I'm gone, novice, and we continue going. And we don't have to exit this trade until we come back to this level and close below the Kijun-sen. Okay? And you can look at your own charts and go back and see how many times this is really good. And there are times where it's shaky, but there's so many things that can help you to stay out of a bad trade if you follow the rules that I just gave you. That'll help you to stay out of a bad trade, so you won't catch a lot of the whipsaws. There are going to be a lot of whipsaws when the market's not trending, but when you catch that trend on the break of a Kumo breakout, you have a good possibility of catching a lot of pips. You know, the hardest one is going to be when the market is ranging or consolidating, but you'll have to see that with the flat Kijun-sen. If your Kijun-sen's flat, the market's not doing anything. You know, but now here it starts moving upwards and price is going upwards. You can see it's pointing up. That's where we want to be going. We want to be going long. And one more bearish breakout here. We have the first candle out of the cloud. Go 26 candles ahead. You got a crossover right here. So you got a twist that's bearish. All right. 26 periods back. I can't go that far, but I know that this was below that price. So those two things, and my third thing, I'm below the cloud. We got the breakout, we take the trade. We go long, we go short. The novice is getting out right here because the market's pulling back. He doesn't realize that the market does go down and then pull back and then go some more. I don't have to get out because my signal to get out is when price crosses the other side of this blue line, the Kijun-sen. And here's where it did that. And that would have been a total exit of 730 pips. Or I could have got out on the fractal level right here. Fractal level. Once the market breaks a fractal level, this is a bullish fractal. If we break that level, then we want to be out of the market. Because if you look at how the market goes, here's a fractal, then here's the high fractal. We don't want to break that high fractal if we're going short. The market doesn't break that high fractal. If it did, it would be going that way. But it doesn't. It goes down, and then it makes another fractal level, goes up, and then breaks that previous fractal level. So it'll keep making these higher fractal levels, but until it breaks one of those higher fractal levels, we don't have to worry about the market, because that's showing us the structure of the market, what it's really doing, the direction that it's going. And you can see it on the other way. The market goes up, makes a fractal, then here's the bearish fractal. The market goes up, makes a fractal. It never broke this fractal, then it made another fractal and goes up. Here's more fractals. It never broke this fractal. So if I just stay in the trade based off of not breaking these fractals, I can go with the market. Okay? All right, so now my other strategy is going to be engulfing candle trade. Basically, if you guys probably know a lot about, some of you guys probably know about bullish and bearish engulfing candles. Well, I have a way of mixing it up with my Ichimoku system. Basically, I only trade at support and resistance levels with everything. Everything I do is at a support and resistance level. It's not going to be in nowhere man's land. I always trade at a support and resistance level. So here's the rules for this engulfing candle trade, and we'll look at the trades and how you do it. All right, so first rule, price must be above the Kumo and the Kijun for a bullish trade. All right, price must be at a support and resistance level, so it could be at the Kumo, it could be at the Kijun-sen, it could be at a fib level, a trend line, or a horizontal support and resistance line that you drew yourself. All right, so the bullish engulfing candle can only engulf a bearish candle. All right, so a bullish engulfing can only engulf a bearish candle. An engulfing candle must engulf the whole body of the previous candle. So it has to engulf that whole body. And then you have to wait for the candle to close. It must close because it might not be an engulfing candle. It may look like one and then come all the way back and be a long pintail wick, and the market goes the other way. If the candle closes too far from support and resistance level, do not take the trade. It's just basically like eating grapes. You got a bunch of grapes, you got a whole bunch of grapes. You're not going to eat every grape because some grapes are bad. You throw those out, you don't eat them, and you eat the good grapes. The same thing here. You don't take the bad trades that are far from support and resistance level. You take the good trades that are near support and resistance levels that can keep you having a tighter stop loss. And then same thing, you exit the trade the same way we did everything else. From the Kijun-sen, if it goes on the other side of the Kijun-sen, break of a fractal level, or any other support and resistance that you would like to do. And so the bearish rules are going to be the same, opposite though, just reversed. And you guys could go back and look at these. So let's go over these bearish engulfing candle trades, okay? Basically, we're looking at the bearish engulfing, this candle right here, engulfed this candle at this resistance level. I had a bunch of resistance levels here. Let me get my red. I like my red a little better. Okay, so this is the candle. This is the resistance level. Look at that flat sink out span B, very flat, strong support and resistance level. So I know I want to take a trade when I see something happening there. The market talks to you at support and resistance levels. It has to do something. And here it talked to me with this long pintail candle right here. And then I had an engulfing candle here. I'm in the trade. I could put my stop loss a bunch of places. I could put it at that support and resistance level. I could put it above the candle, previous candle. I can put it at the Kijun-sen, or I can put it above the cloud. So you have different levels you can put it, and then you can just follow it with your Kijun-sen. And we're getting in this trade, and now we're getting out the same way we did the other trade. There's no reason to get out of this trade until the market comes back and closes up here. Now, again, if there's a fractal level down here and it didn't make a fractal, but if it breaks that level, then you know you want to get out of the trade. And it broke it right here, but it also broke the Kijun-sen at the same time. So we were out of the trade 210 pips. Another one here, bounced off of the top of this resistance level. We need to be near support and resistance. We're on the other side of the Kijun-sen, but now we close below the Kijun-sen. We have to be below the Kijun-sen. Have to be below the Kijun-sen and the Kumo cloud. So we have those two rules. We have a bearish engulfing right here. It engulfs this candle at a support and resistance level, and the market goes down. And here's these fractal levels. The market doesn't break them high, but it keeps making lower fractals and keeps going lower. Okay, and then we hit a support and resistance level again, drops, hits the resistance level again of the Kijun-sen. Look at that level, how it bounces off of the support and resistance, comes down, and now it closes on that side of the Kijun-sen, and we're out of the trade. We exit for 455 pips. There really is no reason for you to get out of the market here. You can just let this ride, even when you see it come all the way back here like this, because if you just follow the rules, I mean, you're going to have some very good trades. You're going to have some bad ones, but you're going to have some good ones too. Here's another bearish engulfing candle at a support and resistance level, the Kijun-sen. Okay, we engulfed this candle here. We engulfed the whole body. Very nice, big candle. So we can put our stop loss a few places. I want to definitely have it be above the Kijun-sen, okay? But then I can go above the previous candle, and then I can go up to the cloud here, and then to get really far I can go up here. That's too far for me. That's probably too far for you. And I told you guys, don't take trades that are real far from support and resistance, because you don't have anything to rely on. Okay, and then the market goes and falls and goes and falls and goes, and here we are. You get out right here. Look how it bounces off of this resistance level again. All right, and you don't have to get out of the trade till here. You know, you don't have to babysit the trade. You just look and see every few hours, when if you're on a 4-hour candle, when that candle is close to closing, look and see where you are. Okay, so we're gonna do a little test here, see if you guys are paying attention. There's 3 candles here. Which candles can you trade? 1, 2, 3, all of them or none of them? Type it in the chat box. Okay, so most people are saying 2 and 3, so let's look at that. All right, so number 1, it's at a support and resistance level, right? So that's one good thing. It engulfs this candle. That's a bullish candle, and then we had a bearish candle engulf it. We're below the Kijun-sen, we're below the cloud. Number 1 is a good candle to trade off of. The trade didn't work, okay? But that doesn't mean it wasn't a good setup. That was a good setup. Number 2, same thing. We're below the cloud, we're below the Kijun-sen, it closed below the Kijun-sen. It engulfs this candle here. Here we get into the trade. Market goes down here. If you wait on the rules, you probably didn't make much. You got out here and you were upset. Probably even got out up here because it came all the way back. And you're not going to allow yourself to get a negative loss, though. That's one thing. Once you see that trade go all the way down here, and if it comes all the way back to your level, and here's the Kijun-sen, you have to have a stop right here now. You have to be smart. You can't take a loss after you've had a big gain like this, and then the market comes all the way back and goes over the Kijun-sen. All right, and then number 3, this is a bearish candle, bearish engulfing. It's a good engulfing candle. It engulfs this candle, which is a bullish candle, but there's a problem. We're above the cloud or inside the cloud. We can't be inside the cloud. We need to be below the cloud, but we're above the Kijun-sen, so we definitely can't be taking this short. We want to be on this side of the Kijun-sen to go that way, and we want to be on this side of the Kijun-sen to go that way, and we're on this side and we're trying to go this way, and the market says no and it goes that way. All right, so number 3 is not a good trade. Once again, which one is good, 1 or 2? Type it in the chat box. If you're saying 2, let's see if you're right. Let's go over this. Number 1 is a really good engulfing candle. Nice engulfing candle, engulfs this one really nice. It's a bullish candle, engulfing the bearish candle engulfs it. But we're above the Kijun-sen and definitely above the cloud. We don't want to be taking no short trades above the cloud. Okay, but the thing is, look at that. You'll be like, well, this worked though. Look how far it goes down. Well, you're not putting the probabilities in your favor by taking things against the rules. So you might as well just be gambling if you're going to break all your rules. That's basically what you'll be doing. Okay, because yeah, this is a good trade, but it was outside of our rules, so it's just one that we let go by. And then our next trade was the same thing. We had the rules, everything was good, but that one didn't work out for us, and then this one did. So it's like, wow, that doesn't look good. But see, that doesn't happen all the time. If you want to win at trading, put the probabilities in your favor. Don't put it in the market's favor. All right, is this a good trade, yes or no? Type in the chat box, yes or no. Is this a good one to take? The majority said yes. Okay, and I'm going to show you something. This is how come we'll start losing at trading. Okay, this is not a good trade to take. This is a very good engulfing candle, and it's humongous, and that's why it's a bad one to take. It engulfs this candle. It's at support and resistance. It's below the cloud. It has all of our rules. It's below the cloud and the Kijun-sen. It engulfs this candle, but it engulfs too far. It's too big. Okay, because now our first stop loss level is here. We're really far away. I mean, so why take that trade? That is really bad. And I would not even look at that candle. I would just say that's a missed opportunity. It's not even a missed opportunity. It's a bad trade. And I wouldn't have taken that one. So that's bad. Remember, guys, don't take a trade that's too far from your stop loss, too big of a candle. So maybe if that candle closed right here, you may think more about taking it. But closing way down here, that is just way, way too far. So you don't take those trades. So we have number one and number two. Which one's good to trade? Okay, I see some people know. I'm going to show you that neither of these are good to take. This one falls under the same rules that we just said. It's too far away from support and resistance levels. We're far from the Kijun-sen, too far to be putting a stop loss. You're going to have a big stop loss with a big candle like that. So that's a bad candle to trade. It's a very good engulfing candle, but a bad trading candle following our rules and what we're doing. And then this one here, it's a nice engulfing candle. Like to see it about that size and about engulfing like that. And it's below the cloud, so that's good, but it's not below the Kijun-sen. It doesn't follow in our rules. We don't take it. And look what happened. It goes down a little bit, fools around, and then takes off and goes the other way. So that was not a good trade. So guys, you have to be underneath the Kijun-sen to go short. The Kijun-sen is the blue line. Don't even look at the trade if it doesn't do it underneath the Kijun-sen. Okay, so that's no good. And don't even look at the candle if it's closing way down here. It's just a losing trade for you, or a trade that you have to sit in forever while the market does this, and then maybe it goes down and comes up. But it's a trade you have to sit in forever. Don't trade it. Okay, another test. 1, 2, 3, and 4. Which ones do we trade? Okay, I see most people have the right answer. Number one, no good, because what does it do? It's engulfing, and I like to see a bigger previous candle, but still it engulfed that candle, that body. So it did fall under our rules. It's under the cloud and it has a support and resistance level, but it is not underneath the Kijun-sen. So I don't take that bullish engulfing. I do have another trade that I could get into that I'm not showing you guys right now that gets me in this trade after the Kijun-sen. Okay, so that trade, no, it's not a good bullish engulfing, bearish engulfing candle trade. This one, number two, is, because look at that support and resistance level. We're right at resistance. Look at how the market is acting like it doesn't want to break that level with these little candles. And then you had a bearish engulfing candle. You get in the trade there, you're close to support and resistance, and that trade works out for you. Number three is no good because this, I don't get in this. I told you the previous candle could not be a bearish candle with a bearish engulfing trade. So this is a different type of trade for me to enter the market, and I get in the market right there. And I have a different way of getting in the market. But no, this is not a good bearish engulfing trade because you need to engulf, the previous candle needs to be bullish, and that's a bearish candle. And then it engulfed the bearish candle with a bearish candle. And then this one here, we don't go long underneath the cloud. This is a bullish engulfing a bearish candle. Okay, and it closed on the other side of the cloud, I mean on the other side of the Kijun-sen, but we're underneath the cloud, so we can't go long until price gets over here. Once price gets past this level, then we can start thinking long. While we're under this level, we're thinking short. We're thinking long here, we're thinking short here. That's how the Ichimoku system tells you which way to go. Thinking short here, thinking long here. Everywhere on the chart where you see that. All right, so the bullish engulfing candle, another one. Here we go. we broke out of this cloud. Now this could have been a Kumo breakout too, but it would have been breakout right there. But then we had this bearish candle. All right, so we missed the breakout, so we wait for some other opportunity. Well, we got a bearish candle, but then we got a bullish engulfing right at support and resistance, right at this level right here. Beautiful trade. You could get in there and just let this market go. There's no reason to get out. And I'm showing you these fractal levels. Do you see the market breaking these fractal levels at all? They're not breaking these levels, they're breaking these higher fractal levels because they're going higher. It's going higher. Now it didn't break anymore here and it broke this level. We're out and it closed below that cloud here. I mean below that Kijun-sen here. So we would have been out right here for 182 pips. But you can see what the market does when it's trending. It makes these fractal levels that you can rely on. I mean really rely on. Go back and study your own charts and you'll see this yourself. Put the fractal levels in and see what the market does at fractal levels, and even look at the support and resistance levels at fractal levels, because look at this fractal level here and look at this fractal level here. It comes right back to it. Fractal level here, this fractal bounced all the way on that level. Here's your fractal level. Prices bounced on that fractal level here, came down right there. So fractal levels are very important and I love them and I use them to death. Alright, so here's the bullish engulfing candle trade. This one is a very nice trade. Engulf this little candle here. Big bullish engulfing candle. There's no reason to get out of this market if you follow this Kijun-sen. Even price came all the way back down, bounced off of here, made a fractal level, right? And then took off. Made a fractal level and then took off. Made a fractal level. I can't make this up. This is what the market is doing. And you can do it on every chart. Study your own charts and you'll see. But it does break the higher levels when it's going higher. See, it breaks the higher fractals if it's going to go higher. But here it couldn't break this level and it started going down. It's going to make a fractal level on a pullback. Maybe it makes a fractal level here and then goes and breaks that level, or maybe it continues down. But once it breaks a fractal, I know that it's out of the structure of the trend. Okay, so that's one thing. That's a signal for you guys to look at all the time. So is this a good trade or a bad trade? Okay, so this is a very good trade. This is a very good trade. Look how big the candle is. I guess that's why you would figure you don't want to take it. But the thing is, look how close it is to support and resistance. That's the thing. That's the main thing. The candle could be this long if you wanted it to, but if it was close to a support and resistance level, you take that trade. That candle closed right here, close to support and resistance, not that far away. So I can take that trade. It engulfed this bearish candle and the market went up and you never had to get out of the market until it closed on the other side of the Kijun-sen here. Okay? So you take this candle because it's close to support and resistance levels. Alright, which trades are good? Both bullish and bearish trades. 1, 2, 3, and 4.
Can you use Ichimoku with ticks instead of time? 0, none.
Okay, you guys got this thing down pat. None of these are good to trade because this is a bullish engulfing. So if it's a bullish engulfing, we want to be going long. We can't be going long because we're underneath the Kijun-sen and underneath the cloud. Same thing with this one. It's above the Kijun-sen, but it's below the cloud. So we have to wait to get on the other side of the cloud. This one, exact same thing. They're all bullish engulfing candles, but they're not where we need them to be because the Kijun-sen will tell us basically where the market is going when price crosses it. Now it crosses there and now we have to get above the cloud. We got above the cloud, then we got a bearish engulfing over a bullish candle. We can't take it. We're above the cloud. We need to be below the cloud and be below the Kijun-sen. So if that candle closed all the way down here, if this candle went from here to here and it was that long, I would take the trade down here because I would be close to support and resistance. But here, we're on the wrong side to take the trade. Alright, so I'm just pretty much closing out. I'm getting close to being done. So none of these are good trades, not a single one of these. And if you just go back and review the rules and listen to the things that I've been talking about, you understand. So guys, you guys have any questions for me? I got about maybe a few minutes here. I'm going to go to the live charts real quick and show you something. Well, I can't. I don't have time. I have to get going pretty soon. But what I was going to show you, I'll probably make a video of anyway because it's just a lot of the bullish engulfing, a lot of the Kumo breakouts today I wanted to go over. Okay, so with the time frame thing, to me, if you're looking at the market and you're using 1 minute, 10 minute, 15 minute, okay, the market's based off of a day, the whole day. So if you're looking at those time frames, you're getting a little bit of the picture. To get the whole picture, you got to see what the market does the whole day. So that daily candle tells you what the market's doing the whole day. So if you want to go down to a 4 hour candle, that's good. Now, yes, you can trade Ichimoku with the lower time frames, but with anything, it's going to be more reliable on the higher time frames. Even when you draw your support and resistance levels in, you need to draw those with the daily time frame, and that's what you base everything off of. Everything's really based off of the daily time frame. That's where you get the picture of the market, the daily time frame. If you're looking at the minute or the 10 minute, you're getting a tiny percentage of what's happening in the market, and you need to be a really good trader to trade those short-term market, the short time frames. I'm not that good to trade the short time frames. I think they're sporadic and all over the place, and it's hard to really get any structure or form of what the market is really doing. So that's one thing. I can't really trade those. I used to trade stocks. I don't trade stocks anymore. They don't move enough for me. They sit still too long, and then they're all based off of the news. You got to have news for them to move, and I don't like trading stocks. I like to see something that's moving where I can do some analysis of it. Use ticks instead of time. I don't. I never use ticks, so I can't give you a good answer on that one. Do you need a Kumo twist for the bullish candle entry? The bullish candle entry, you have your future has to be bear. If you're going long, which is going to be bullish, you need a bullish twist. So you need a bright future. If you're going short, your future always has to fall with you, okay? Now some traders may take that trade. Now that's my rule is with the future, okay? And that's just like I told you with the grapes, don't eat every grape because all the grapes aren't good. Some may be bad, and you don't want to eat the bad ones. So wait for the good ones. Wait for the high probability trade. You guys look at a trade at a chart and say, man, I missed that trade. You did miss that trade, but there's going to be so many more of them. How do I pick my markets? Basically, I have about 10 pairs that I really like to look at, and I keep them up on my chart all the time. I look at them all day. I look at the 4 hour time frame and the daily, so I only have to look at my charts really every 4 hours. I do some analysis in the morning, and then I really don't have to mess with the charts anymore. Look at them at 12 noon and then 4 o'clock, and that's it. You look at the every 4 hours. I don't use the Tengensen not used in any of these strategies. Do I use daily and weekly for a reference for 4 hour entry? I did a video on that, and it really confuses a lot of people when you look at the 4 hour and that daily and trying to compare the times. When you're making a trade on Ichimoku system here, what I'm going to tell you is trade your time frame, because when you got the signal was in the 4 hour time frame. If you got a strong signal in the 4 hour time frame, you take that trade, because basically a trend starts on the lower time frame and works its way up. And then on the daily time frame, you could be looking at a pullback. So a pullback could be a good 130, 150, almost 200 pips, right? So if you're taking a pullback on a 4 hour time frame, that's going to be bearish, but the market may be bullish on the daily. So you're just taking a pullback trade. So it's kind of confusing if you do it like that. I've shown it on my YouTube videos, and I'll do some more videos about that, because that's one thing that a lot of people seem to be stuck on. But for me, I trade my time frame because that's where I got the signal. And if I look at the daily and I say it's I can tell, well, I can see if it's a pullback level or maybe a total trend change. A lot of times, if you're going to have a change of trend, you'll get a maybe like a formation, like a double top or double bottom. Those are where you get a lot of change of trends. So if you don't see it around that area, it might just be a pullback. How to do analysis in my next webinar. I'll get it. I'll get that in there.
Do you try to project a take profit level with fibs or just wait for the Kijun-sen cost tags?
Uh, I don't. I project levels with support and resistance, and fibs are support and resistance, but I don't use them for that. For that, I use them for pullback entries, but not for projecting my next level. My next level, I look at the chart and do analysis of support and resistance, and that's where I get into the chart to the trade. Okay, and then what I also do is just wait on that Kijun-sen. That's the equilibrium point. And if you follow equilibrium, you're basically going to be right a lot of times. All right, guys, so I'm about to close out here. I have a few things that Michelle wants to tell you, and then we'll end out here.
So thanks for the comments about the webinar being a great webinar. We always strive to try and help you to just learn and grow and add any interesting tidbits of information that you may or may not already know, but it will hopefully help you to increase your knowledge. If you take a look at the screen, the word longevity comes up, and as you know, longevity is the sign of success. And so what is success in reference to the Ichimoku system? Let's take a look at how many people have come and gone teaching this system. As you know, lots of people have come years and years ago, 3 years ago, 4 years ago. You'll find that there were a lot of teachers that were trying to teach the Ichimoku system. And then today, where are they? They've all pretty much faded off the radar, and they're pretty much gone. So lo and behold, here comes Chaos Trader 63, and you'll probably ask yourself, well, where did he come from? Well, while others were kind of coming and going, Chaos Trader 63 was studying. He was learning how to measure the momentum of an asset. He was figuring out how an asset is trending, and he was pretty much finding out where its support and resistance points are. And then once he mastered the system, he began trading and then teaching it. So we know that the Ichimoku system is pretty much a complicated system, but hopefully you'll be able to quickly sort through what seems to be an overwhelming amount of information by watching and attending these webinars. So we are offering, FX at One Glance is offering an interactive 4-week Ichimoku training course. And in this course, it's a comprehensive 4-week live interactive web meeting. It's going to be created to help you learn to trade successfully using the Ichimoku training system in the market at any time and any time frame. So August is pretty much full, so thank you so much for all of your support. September has some openings. You definitely don't want to miss this class. You can actually go onto our website and sign up, fx@oneglance.com, and you can learn how you too can get started on a path to success. So we look forward to seeing you there. Take a look at the screen there, and you'll see that what you'll learn when you go through this course. You'll learn money management, support and resistance, Fibonacci, fractals, price action entry techniques, stop loss and trade management. You'll have one-on-one scheduled mentoring for a year, recorded sessions, market commentary, and then video and email trade alerts. Please take a look at that one-on-one live scheduled mentoring for 1 year. That's something that's not offered anywhere else, and so we want you to take advantage of that if you can. The cost of the course is a one-time fee of $500. It's a 4-week long process, and you will definitely have that one-on-one scheduled mentorship for 1 year. So definitely go on to our website again and check it out. You can definitely take a look at fx@oneglance.com to be able to take a look at that process, okay? So we won't be doing the one-on-one live scheduled mentoring for 1 year for a long period of time. We're definitely going to have to try to limit that. So if you want to take advantage of that, please try to do so as soon as possible, because that's something, like I said, that's not offered, and you want to take advantage of it while it's available, basically. So Thank you so much for coming out again, coming to this webinar. Thank you for the comments there, and we hope that all of you were able to hear and get a good feel for what this is. It was actually recorded, and we will be able to offer that to you online. So take care, have a great evening, and we'll see you next time.